Ever wonder where your mortgage rate actually comes from? Is it just a random number your bank makes up? The truth is so much deeper. Most people think when mortgage rates go up, it's all the Federal Reserve's fault, but the Fed only sets the floor. The real action happens somewhere else entirely. So let's start with the big secret. Your mortgage rate isn't controlled by your local bank. It's tied to the global economy's heartbeat, the 10-year Treasury bond. Think of it as a signal. Every lender, every investor, from New York to Tokyo, watches this yield. It tells them everything about long-term stability, inflation, and recession fears. Here's how it works. When inflation spikes, investors get nervous. They demand higher returns on their money to make up for the loss of purchasing power. That pushes the 10-year Treasury yield up, and mortgage rates get pulled right along with it. On the flip side, when recession fears grow, investors run for safety. They pour money into secure Treasury bonds, which pushes yields down, and suddenly mortgage rates start to ease. This is why your mortgage rate can swing wildly, even when the Fed hasn't said a word. It's all about risk, expectations, and the constant buying and selling in the global bond market. But it gets even crazier. Your mortgage doesn't just sit in a vault at your bank. It gets bundled up with thousands of other home loans, transformed into a financial product called a mortgage-backed security, or MBS, and sold to investors all over the world. We're talking about massive pension funds, insurance companies, hedge funds, even foreign governments buying up pieces of your home loan. These investors need to make a profit. They demand a certain return, a spread, above the safe 10-year Treasury yield. If those investors get nervous about the housing market or the economy, they demand a bigger spread. And guess what? That translates directly into a higher mortgage rate for you, the borrower. If they feel confident, the spread narrows and rates fall. This means what happens in the rest of the world directly affects your wallet. A banking crisis in Europe could actually lower your mortgage rate as global investors rush to the safety of U.S. bonds. A big sell-off in Asian markets could raise it. It's a completely interconnected global system. The rate you're quoted isn't just about your finances. It's about global events you've never even heard of. And on top of all that global machinery, the lender adds their own layer of pricing based on your personal risk. This is where your credit score, down payment, and debt-to-income ratio come in. Lenders call it risk-based pricing. A higher credit score and a larger down payment signal lower risk, so you get a better rate. A lower score or smaller down payment means higher risk, so the lender charges you a premium to protect themselves. This is why two people can apply for a mortgage on the exact same day and get completely different rates. The bank isn't trying to rip you off. They're running a sophisticated calculation to price the risk that you might not be able to pay them back. But there's another risk that keeps lenders up at night, one most borrowers never consider: prepayment risk. It's the mortgage industry's biggest nightmare. Here's why. When interest rates fall, what does everyone do? They refinance into a cheaper loan. For investors holding those mortgage-backed securities, that's terrible news. They were expecting years of steady interest payments, and suddenly that income stream is gone. They lose money. To protect themselves from this uncertainty, lenders bake an extra premium into every single mortgage rate they offer. It's a buffer against the chance that you'll refinance and they'll lose their expected returns. So a part of the rate you pay is basically insurance for the lender against you finding a better deal down the road. Now, here's a tip that can give you a huge advantage. Mortgage rates don't follow the economy. They lead it. They are a forward-looking indicator, pricing in what the market thinks will happen with inflation 6 to 18 months from now. Mortgage rates almost always peak before a recession officially starts and start falling long before the Federal Reserve announces any cuts. Why? Because the bond market is a prediction machine. It's constantly analyzing data and placing bets on the future. So the mortgage rate you see today isn't about today's inflation numbers. It's a forecast of tomorrow's. If the bond market believes inflation is cooling faster than the news headlines are reporting, mortgage rates will drop before anyone else sees it coming. This is why waiting for the perfect rate is a fool's game. The market moves in seconds. A single jobs report or inflation number can cause rates to jump or fall by a quarter point in a day. The market is volatile, and trying to time it perfectly is nearly impossible. This leads to a massive psychological trap for homebuyers. When rates are low, everyone rushes in. Fear of missing out takes over, and people get into bidding wars, driving home prices through the roof. Then, when rates are high, fear takes over again. People get scared and refuse to buy, even though higher rates often lead to lower home prices and less competition. Most people follow the crowd and their emotions. But the math is simple. High rates can mean better prices, while low rates often mean you're paying a premium just to get in the door. There's another huge piece of the puzzle that most Americans take for granted: the 30-year fixed-rate mortgage. This type of loan is an American anomaly. In most other countries, like Canada or across Europe, borrowers are stuck with variable rates or have to renew their loans every few years at whatever the current market rate is. Imagine your mortgage payment doubling in 5 years. That's the reality for millions around the world. In the US, government-backed entities like Fannie Mae and Freddie Mac guarantee most mortgages. This guarantee makes those mortgage-backed securities incredibly safe for investors, which keeps rates lower for everyone. Without them, the 30-year fixed loan probably wouldn't exist, and our rates would be significantly higher. So when people complain about U.S. mortgage rates, they often forget they're benefiting from one of the most stable and subsidized financial products on the planet. And finally, let's talk about the elephant in the room: government debt. When the government spends more than it takes in, it has to borrow money by issuing more treasury bonds. More supply of bonds means investors demand higher yields to buy them all up. And as we already know, when treasury yields go up, mortgage rates follow. So, in a very real way, government spending policies can indirectly push your mortgage rate higher. If investors ever start to doubt the government's ability to pay back its debt, yields could skyrocket and mortgage rates would surge, regardless of what's happening with inflation. So, to wrap it all up, your mortgage rate isn't set by a politician or a news anchor. It's the outcome of a massive interconnected global system. It's a blend of inflation expectations, recession fears, global investor demand, government debt, and your own personal financial risk. It's a constant tug-of-war between enormous pools of capital, all trying to predict the future. When you understand this, you stop guessing and start thinking like an investor. You see the bigger picture. Everyone talks about mortgage rates, but nobody ever explains the real forces that shape their future. Let's break down the part you won't hear on the news, the hidden cycles that determine where your mortgage rate is actually heading. Rates don't rise forever, and they don't fall forever. They move in long, multi-year waves driven by a few key factors: inflation, central bank actions, debt, and investor psychology. Once you grasp these cycles, you'll see why most mainstream forecasts are either too simple, too late, or just plain wrong. Let's start with the big one: inflation. Mortgage rates only fall for good when inflation is truly defeated. I'm not talking about a temporary dip because gas prices got cheaper for a month. I mean a consistent downward trend in core inflation across many different sectors. One of the biggest parts of inflation is shelter costs, and here's the secret. Shelter inflation in the official data lags the real housing market by about 9 to 12 months. This is huge. It means mortgage rates can stay painfully high even when rent prices have already started to cool off. The official numbers just take a long time to catch up to reality. Another factor that almost nobody discusses is the Federal Reserve's balance sheet. When the Fed does something called quantitative tightening, or QT, it's basically selling off its holdings of government bonds and mortgage-backed securities. This floods the market with more supply, and just like anything else, more supply means lower prices and higher yields. Higher yields on these bonds directly translate to higher mortgage rates for you and me. So even if the economy is slowing down, your mortgage rate can stay high simply because the Fed is shrinking its balance sheet. On the flip side, whenever the Fed hints at stopping QT or starting quantitative easing, or QE, mortgage rates can drop like a rock, sometimes even before a single official rate cut. It's the flow of money, not just the talk, that moves the market. Now let's talk about jobs. This is a critical trigger. Mortgage rates don't just drift down, they tend to fall sharply, but only when unemployment starts to rise in a meaningful way. As long as the job market is strong and everyone has work, the Fed feels no pressure to cut rates aggressively. Investors know this, so they keep their expectations in check, and mortgage rates stay elevated. But the moment the labor market shows real cracks and job losses pick up, that's when you see rates collapse. Historically, every major drop in mortgage rates has started right after unemployment began to climb. This is why things can feel so calm right before a major shift. And it's not just about the US economy. Mortgage rates are global. When central banks in Europe or Asia start easing their policies, or if their economies slow down, international investors look for a safe place to park their money. That safe place is often US Treasury bonds. A flood of foreign money buying up our bonds pushes their yields down. And because mortgage rates are tied to those yields, our rates here at home can fall. A recession in China or Germany could actually lower your mortgage payment, which shows you just how interconnected everything is. Then there's investor sentiment. Mortgage-backed securities, the assets your loan gets bundled into, have to compete for investor money. If corporate bonds or other investments suddenly start offering a better return for a similar level of risk, investors will sell their mortgage bonds and buy those instead. When that happens, lenders have to raise mortgage rates to make them attractive again. This is why a crisis in a completely unrelated part of the financial market can suddenly cause mortgage rates to spike. It's not about housing, it's about where big money is flowing. Here's another deep level factor: government debt. Our government is constantly rolling over its old debt. As bonds that were issued with low interest rates years ago mature, they have to be refinanced at today's much higher rates. This makes the government's borrowing costs go up. Investors watch this like a hawk. If they start to worry that the government's debt is getting too expensive and unsustainable, they'll demand higher interest rates on new bonds to compensate for the extra risk. This pushes up Treasury yields and, you guessed it, mortgage rates. Fiscal policy and government spending habits have a direct, though often invisible, line to the rate you're offered on your home loan. Let's bust a common myth. Mortgage rates will fall when the Fed cuts rates. Not necessarily. Mortgage rates fall when the market is convinced that future inflation is under control and long-term economic growth is slowing. If the Fed cuts rates while inflation is still a problem, investors might panic, thinking the Fed is making a mistake and letting inflation run wild. That fear can actually push long-term rates, including mortgage rates, higher. The timing and the reason for the cut matter far more than the cut itself. So, looking ahead, what are the triggers for the next big drop in rates? You need to see a few things happen at once. A sustained fall in core inflation, a genuinely weakening labor market with rising unemployment, a clear slowdown in consumer spending, and a shift in global money flows back into the safety of U.S. bonds. When these forces align, rates can fall dramatically. I'm talking 1 or 2 full percentage points in just a few months. We saw it happen after 2008, after the dot-com bust, and during the early days of the pandemic. But here's the most important truth that many people miss. Even when rates fall, it doesn't automatically make housing more affordable. The moment rates drop significantly, demand comes roaring back. All the buyers who were sitting on the sidelines rush in, investors jump back into the market, and sellers regain the upper hand. Home prices can start rising again almost immediately. This means that waiting for lower rates can be a trap. Sometimes, the best time to buy is when rates are high but the market is quiet, because you have less competition and more negotiating power. Finally, let's zoom out to the big picture. For the last 40 years, the overall trend for mortgage rates has been downward. This is due to big structural forces like an aging population, slowing productivity, and a global surplus of savings. The recent spike in rates was the exception, not the new rule. Unless we enter a new era of permanently high inflation, which the data doesn't currently support, the long-term path for rates over the next decade is likely lower. But the journey there will be volatile. Expect sharp swings and sudden moves based on new economic data. Understanding how mortgage rates work isn't just about predicting a number, it's about decoding the entire economic machine. The more you understand the forces pushing and pulling on the rate you're offered, the smarter your decisions will be. Whether you're buying, refinancing, or just trying to understand the world, this knowledge puts you light years ahead of everyone else. Thanks for watching, and be sure to subscribe for more insights that go beyond the headlines.